Hi guys, welcome back to my channel. Today we're going to start investing. Whether you've got £5, whether you've got £10, whether you've got £100, I'm going to introduce you to the world of ETF investing, which sits in the pool of medium risk investments if you watched my previous videos about the mindset you need to have before investing. Now, I think so many people have been focused on buying S&P 500. Everyone I hear talking about investing in ETFs almost always talks about investing in S&P 500. And I am here to break it down for everyone to understand what is going on there, to know how they are going to invest, what they are expecting to gain, what they are expecting to lose, and also understand what they are doing. Because I think most people are just throwing money into S&P or whatever and not sure what they are doing just because everyone else is saying, oh, you need to invest. So I'm going to break it down. I'll start with a very simple, silly example, but that's going to help you understand what this world of ETFs is all about. Let's get right into it. So let's assume that you are a mom, a housewife who's taking care of her children, and you go shopping every week. And you've realized that the things you bought last year at the same time have increased in price this year. And some of them have increased in price, not at the same percentage. So some of them have increased in price by 5%. Some of them have increased in price by 15%. And you are somewhat thinking of creating a business out of it. So you go to the grocery shop with £100 now, with some expectations, and you buy 5 things. 1 tin of tomato puree for £12, 1 bag of rice for £50, 1 tin of milk for £8, 1 bag of cocoa powder for £20, and 1 bag of coffee beans for £10. You've checked the expiry date for all of these and you understand that they are going to last 2 years. So what you're planning to do is you are buying all of these for £100 in total, and you will keep it at home, and next year you're going to come and sell it. So the assumption here is that you can easily buy it and you can easily sell all these things. So let's say next year you come in and the tin of tomato puree that you bought is now £20. The bag of rice you bought is now £65. The tin of milk you bought is now £10. The bag of cocoa powder you bought is now £25. The bag of coffee beans that you bought is now £15. Now, when you put it all together and you're selling it, you're going to make £135. So in this case, you invested £100 by buying all of these products. When you sold all of them next year at the same time, you got £135, meaning you made 35%. But if you look at it into details, not all these individual products made 35%. So the tin of tomato puree went up 66%. The bag of rice went up 30%. And the tin of milk went up 25%. I hope you get the gist of where I'm trying to arrive at. So last year when you bought all these things for £100, you weren't sure which was going to go up so much. Because if you understood that the tin of tomato puree was going to go up 66%, you probably would have used all the £100 to buy that. But because you don't know the future and you don't know which one will go up the most in terms of percentage, you diversified by buying different things with a particular criteria. Maybe your criteria was that the expiry date should be in the next 2 years so that you can sell it in the next year. So you diversified by buying different things in different proportions. And in that case, those that did not go up as much were pulled a bit higher by those that went up so much more. So that at the end of the day, your money all in all went up. Now bear in mind that you could have gone back to sell and maybe the bag of coffee beans had dropped in price because let's say coffee was very popular when you were buying it, but now nobody is buying coffee anymore because maybe everybody is buying matcha. and you weren't sure whether coffee price was going to go up or down. So because you bought other things in that portfolio, in that basket, that went up, now the effect of coffee price going down did not greatly affect you as much because you did not put all your money in coffee. So now when you think about ETFs, that is the simple explanation of what you are buying into. Now let's assume that you've been doing this every year and you've been making money through this. Let's put inflation aside. Let's just take the raw figures. So you did this for like 5 years and you've made about £500 just by doing this buying and selling year by year. And now your family know about it. So your family says to you, instead of you going to buy the stuff for £100, we've gathered that you have some skills in choosing the right products that actually go up due to inflation, or you do some research on the side and you realize that, oh, this trend is coming into the system, so I'm going to buy the ingredients that people use for this particular product, for instance. So let's say it's matcha that you found out that, hey, it's become a trend, everybody's buying matcha. So then you decided to buy matcha this year in that basket and you bought a bigger percentage of your money in matcha. And it actually played out as you expected. So then now that your family is aware, they are saying that, oh, they will all give you £100. So when you put it all together, a family of, let's say, 10 people, so your cousins, your aunties, your uncles, now you've got £1,000. So now instead of buying just £100 worth of goods, you are buying £1,000 worth of goods with your knowledge and research and information that you know. And whatever you make next year, you will come back and share it with your family members. So let's say you now have £1,000 in hand, you're going to do the shopping, but you've agreed with your family members that at the end of it, when you finally sell what you've bought, whatever the net value is, whatever the value of the sale is, you're going to take 1% of it as your fee. So let's say you bought the stuff for £1,000 and then you were able to sell it for £1,500. So let's say you've made 50%. So the £1,500, you are going to take 1% of £1,500 as your fee for doing that transaction. And that is what ETF providers are doing. So because they've made it easy for you to be able to contribute little sums of money, £5, £10, £20, which is all summing up to make the £1,000 that they are going to use to buy these individual companies in the ETFs, they are charging you a fee for doing that transaction. I hope that makes sense. Now let's come into the world of investing. So S&P 500 is one of the most common ones, and I will give you a breakdown of how this works. So if you look at the US economy and the stock exchange, we have so many companies that are listed on the stock exchange, and a provider or the S&P 500 index is put together by a company. We're not going to go into that. But the company is saying that, hey, I'm going to value, and you value these companies by multiplying their share price times the number of shares they have outstanding. So I'm going to value the top 500 companies. So the biggest 500 companies on the stock exchange in America, I'm going to value them and arrange them by the top 500. So maybe let's put some numbers out there. Let's put some examples in there. So let's say maybe there's Walmart in there, there is Apple in there, there's Facebook in there, and they've arranged them by how valuable they are. So in that case, the top 500 companies are the ones that are thriving well in the economy. So if you think about it, the risk of buying one company and the price of that company going down is now lower because you are exposing yourself to buy 500 companies, which are the top performing companies in the US. But you are buying just a little bit of it. So you are that family member that gave this lady who does her shopping, you gave her £50 and someone else gave her £100 and someone else gave her £500 and she put them all together and got £1,000. So your £5 that you're using to buy a bit of the S&P 500, which is now an ETF that you are buying into, you are contributing to the pool that goes to buy all the 500 companies in that proportion. Now, the companies that have the highest valuation, so let's say in the list of 500, the biggest company is maybe let's say $100 million, and the smallest company is, let's say, $1 million. So they will buy it in the percentage of the makeup of the 500 companies. So let's say if you put all the 500 companies together, you're going to have them being valued at 1 billion, right? But in that, let's assume Apple is $500 million worth in the 1 billion. But let's say Walmart is 20 million. So if you look at this in percentage wise, Apple makes a bigger percentage of the basket compared to Walmart. And you are buying that percentage of each of the companies and how they are arranged with your £5 that you're holding. I hope that makes sense. And so when the companies go up, your £5 will now be tracking the percentage increase in their ETFs. When the companies go down, and not all of them go down, so some of them will go down, some of them will go up, but depending on their weighting in the S&P 500, they will affect how the S&P 500 is valued. So if the biggest weighting goes up by 2%, it will affect it higher compared to if the smallest weighting goes up by 10%. I hope this makes sense. Now, I want us to dig into other ways of thinking about ETFs. I know that S&P 500 is the most talked about example, but if you think about it, there are different stock exchanges in the world, and most of the time there are ETFs that track the performance of those indices. So there are various indices that are created, and when I say indices, it's a collection or group of assets such as stocks, bonds, that is used to track the performance of a specific sector or a broader market. So even in the US, for instance, there are several indices that track just maybe a sector. So maybe the finance sector, maybe the insurance sector, maybe the FMCG sector. And those indices would also have several companies, stocks, bonds, whatever it is that you're looking at. So when you buy into the index with an ETF, it helps you to track the performance. So how do you know which one to buy? That is where some research comes in. So let's say you have no idea what you're doing. You can just buy the broader market. You are literally buying the economy. And so let's say if you're looking at the US, you can buy the S&P 500. If you're looking at the UK, you can buy the FTSE 100, FTSE 250. So FTSE 100 has the top 100 companies in the UK that are listed on the stock exchange. And FTSE 250 have the top 250 companies in the UK that are listed on the stock exchange. One thing I want us to think about when you're thinking about these indices is they are not only limited to the big economies. They are not only limited to developed markets. There could be indices across several markets. So there are indices in China, there are indices in Hong Kong, there are indices in India, there are indices in even Ghana. There are indices everywhere. But then you need to understand whether there are ETF providers, which is this lady who goes for her shopping, who have made it easy for you to buy the ETF to get the exposure of the index. Now, when you're doing your research, hopefully you're reading world news, you're reading what's going on in the market, and you come up with, oh, this trend seems to be going higher. Let's take tech, for instance. So there's an index that tracks US tech stocks, which is the NASDAQ, which has ETFs that you can buy into. So in this case, let's say you want to buy tech stocks in the US because you think that they will keep going higher. You can go and find ETF providers for NASDAQ and buy into the ETFs. Now, let's say AI is becoming a topic and you're thinking this AI thing is going to rule the world. Wherever their value is now is going to go higher. So you can look for ETFs that track AI stocks and buy those ETFs. Let's say you're thinking that China is going to rule the world or China is becoming a very huge economy and you think that the Chinese economy is going to grow faster and also is going to grow further than it currently is. You can look for indices or ETFs that track Chinese economy. So it could be the Chinese stock market. It could be a particular sector in the Chinese market that you want to track. and then you buy those. So I just want to say that don't limit yourself to S&P 500 just because that's what everyone is talking about. If you've done some further research or you just want to hop onto a trend and you're thinking this thing has got legs, this has got a future, AI has got a future, EV cars have got a future, this particular country, let's say India, is improving, the economy is getting better, and you want to have an exposure to those, you can buy those ETFs. Now, next step, where do you buy the ETFs? So in the UK, and it could be different depending on which country you're sitting in, you can buy ETFs through some providers online, and it's quite easy to open an account. I'm going to go through a list of some of the providers. I personally have accounts with Fidelity, I have accounts with Saxo Markets, and I have an account with Vanguard. When I checked online, there were some other providers that you can look into. Some of the other providers I found when I researched online are Trading 212, Freetrade, Hargreaves Lansdown, and eToro. Now, if you're choosing to invest through any of these, you need to do your research to check whether they are credible, to check whether other people have used them and what experience they had with them. You would usually set up an account and they would require some ID, some information about where you are taxed, so where you are tax resident, and also whether you are buying it through some vehicle. I would advise, if anyone is looking to start trading some of these ETFs or buying some of these ETFs, to look to buy it in stocks and shares ISA so that it's tax efficient. And the stocks and shares ISA allowance per year is 20k tax free. So if you invest 20k into stocks and shares, ETFs, whatever, within a year from April to April, the amount or whatever you make on it is usually tax-free. The next thing I would go into is how to buy these ETFs. So let's say you've done this research and you've concluded that, okay, I'm going to be buying 3 ETFs. One that gives me an exposure to the US market, one that gives me an exposure to AI stocks, one that gives me an exposure to the Chinese economy. Now, one thing that helps for you to have your money working well for you is dollar cost averaging. What is dollar cost averaging? It is an investment strategy where a fixed amount of money is invested at regular intervals, regardless of the asset's price. This strategy aims to reduce the impact of market volatility on the overall cost of the investment. By investing consistently regardless of price fluctuations, investors can potentially lower their average price over time, especially during market downturns. I'll put this in an easy way for you to understand. So I'm going to share my screen here and explain. What dollar cost averaging is trying to do is that, let's say every month you put £500 into these 3 ETFs that you've identified, but you are not trying to time when is the lowest and when is the highest, because it's hard to be able to tell that. So what you do is, whether the price is down or the price is up, you just buy £500 worth of these 3 ETFs every single month. I will use S&P 500 chart as an example for you to understand. So let's say you got the idea to start buying S&P 500 in 2019. This is why dollar cost averaging is very important. So in this case, if you look at my screen here, so let's say in December 2018, you bought at 2,448.34. Then as time went on, in January, you bought 2,644. So the price was going up. So what you had bought earlier here, you had gained some money on it already. So if you bought £500, you would have gone up a little. Let's say in April that year, you bought 2,904. Let's say in July that year, you bought 2,994. Now you get the gist. Now let's say that COVID hit and the price dropped to 2,405. At this point, if you are trading it, if you are thinking, oh, I'm going to buy low and sell high, and if you remember the panic that we had in the market in terms of what will COVID do to us, you probably would have thought, oh, my money has gone down, let me sell. Because most people operate with fear and greed when they are trading the stock market. So if at this point you were not dollar cost averaging, you probably would have sold. But now that we have it as history, we can see that if you rather bought when it dropped, let's say March, your money for your £500 was ready, and then you bought some, it would have climbed back up, and then in May, you would have bought some again at 2,867. In September, around 3,300. In March the next year, we were already way high above every other place that you had bought this S&P 500. So what dollar cost averaging would have done then is the one you bought in 2018 would have now gained to this level. The one you bought in 2019, all those little £500 would have gained to this level. And the one you also bought in March 2020 when COVID happened would have now gained way more. So if you are dollar cost averaging, you are not checking where the market is low and where the market is high. All you're saying is, I have a long-term strategy to keep buying the S&P for the next 10 years with the aim that every single dollar I'm putting in is going to make money by the time I am exiting. Because I don't know how to time the market. I don't know when is the lowest and when is the highest. And if I wait, the price of the S&P will probably go higher than where I think is the low point to enter. So dollar cost averaging works so well for so many people who have no idea how to time the market. And to be fair, timing the markets is sometimes a gamble, because you'll be thinking, oh, the price will drop to 2,400, and it never drops to 2,400. So you never got the chance to invest. So dollar cost averaging helps you for every single dollar you put in to make money. And it can now become a passive way of making money, because you have your automated direct debit, which automatically buys S&P or whatever index you're looking at. And every month you put some in there. So now each of the sum you put in there every month will start trading higher. And overall, you're going to make money as it goes higher. So some points of caution that I need to put out there when you're investing in ETFs is, one, you need to check the fees. So check the fees of the platform, the provider that you're using to buy the ETFs that you want exposure to. And make sure that you're getting the cheapest, because if you don't do the comparison, you wouldn't know who you're saving more money with if you invest in those ETFs. Number two, be aware of currency risk. So let's just assume again that you're buying S&P 500. Obviously, S&P 500 is a dollar-based index. But if you are purchasing it, let's say in the UK, maybe there could be some ETF providers who have created an ETF that is denominated in GBP. So be aware that even though you're buying it in GBP, there is a currency risk in there where the person who has created that ETF purchases it in dollars and then converts it to GBP for you to be able to buy GBP and have that exposure. And also to be mindful whether you are investing for the long or short term. As I said in my previous video, you need to have your goals before you start investing. So if you've not set your goals, please go back and watch that video somewhere here. I'm going to link it somewhere here, and invest wisely. So knowing what you're trying to achieve, which can help you decide which ETFs to invest in. So to crown this off, I will talk about my personal investing and what I put my money in. So I do buy monthly some S&P 500, and I buy some NASDAQ. And also I do buy some emerging markets ETFs. So I do want exposure to emerging markets, because even though S&P 500 and the NASDAQ are already in the developed markets, which is in the US, I do have some biases towards some emerging markets and their rate of growth. Examples are India and China. And so because of that, I have a smaller percentage of my monthly direct debit that I use to buy emerging markets ETF as well. Thank you so much for watching today. I hope this was helpful. I hope from here onwards you can be confident in buying some ETFs and watching it grow your wealth. All the best. If you have any questions, if you have any comments, if you think I should do a follow-up video of some parts of what I said in this video, please put it down in the comments and I will get to it and make sure that you have that. It's been Abigail. See you later.